Why real estate became even better than gold with the new Trump tax changes. So we're going to learn a lot about that today, and you'll see it's more of a collaboration than it is a debate of any kind, but hopefully we'll all learn something. So I'd like to introduce first a couple of the panelists and then your moderator. From the gold side, the president of American Gold Exchange, and a guy who knows a ton about bullion, but also about the numismatic coins as well. Please welcome, all the way from Austin, Texas, Mr. Dana Samuelson. Come on up, Dana. When I asked Brian London, who writes the Gold Newsletter and who promotes the New Orleans Investment Conference, who the best gold dealer was, he said Dana, so that's good enough for me. On the other side, from the real estate side and all the way from Hawaii, let's welcome a gentleman who has a background in engineering, now turned into full-time real estate. He quit his job 4 months ago. Hundreds and hundreds of units, or doors we call them in real estate. Lane Kawaoka, come on up, Lane. Lane also, He has a great blog called Simple Passive Cash Flow and a podcast as well. And then your moderator is from Concordia Real Estate. He specializes in investment in the retail space, specifically shopping centers. He's done that for a whole bunch of years in places all around the country. So please welcome our good friend, Mr. Michael Flight, your moderator.
Thank you, Robert Helms. For those people that don't know who Robert Helms is, Robert is one of the experts in the real estate field. He is the host of the Real Estate Guys podcast. Him and his partner, Russell Gray, are just phenomenal with all kinds of financial instruments, so I would highly recommend the podcast. And then the other thing is, if you are looking for a good time at sea, you should check out their Investor Summit at Sea, because they have some really phenomenal names on there. You will learn about gold, you will learn about all kinds of other crazy things from Peter Schiff and all the rest of it. But these guys with the Real Estate Guys, I can't talk highly of them enough.
Oh, so, go on.
So again, I'm Michael Flight with Concordia Realty. I appreciate you all coming today. We're going to talk a little bit about how gold and real estate can be excellent hedges against inflation, and also real estate can create cash flow. And a little bit of about how gold actually created the West, because as I was talking to Dana here, it's like the main thing that kick-started the settlement of the West is the gold rush. They were doing the whole, why don't you go out and homestead? So there were a lot of people that never made it out to California for the gold rush and just kind of like stayed where they were. So with that, Dana, why don't you give us a little bit of information about what you do?
Thank you, Michael. It's great to be here. So I'm president of American Gold Exchange. We're a national mail-order physical, precious metals, and classic pre-1933 U.S. and European gold coin company. We operate out of Austin, Texas. I've been in the business 40 years. I worked for other people, learning the trade, learning the craft for 20 years, and I decided to go into business for myself in 1998 when gold was about $300 an ounce, and we've watched it go up a lot higher since then. We have an impeccable national reputation for fairness, transparency of pricing, and honesty. We try and help people, if you're interested in physical gold or the gold market, understand what might be best for you and how to facilitate those transactions.
All right, fantastic. And Lane, why don't you give us a little bit of a introduction to the type of things that you do?
So about 2009, I started to listen to a bunch of podcasts. Robert's Real Estate Guys podcast was one of them. Bought a turnkey rental, and it was $2,200 a month rent, and the PIT I was $1,600. To a young 20-year-old kid, that was a lot of beer money, and I didn't quite like my engineering job, so I started to focus all my energy to picking up more rentals. Fast forward 10 years later, I currently own 2,600 units, mostly private placements and syndication investor. So I'm more of a deal guy. I like multifamily apartments and mobile home parks today.
But the guy retired at 33. Can we give him a hand for that? He's actually working full time, but.
Oahu.
So, and then our next panelist is Robert Helms. And Robert, why don't you tell us a little bit about all the things you have going on?
Well, we don't have that much time, but I'm a collector of real estate. I am fortunately born into a real estate family. My dad bought his first investment property in 1957, so he's invested in 7 different decades. And this is him, Bob Helms, who become the godfather of real estate. So I've learned everything I know of real estate from Bob, but he hasn't quite taught me everything he knows, so we keep him around for that. I just think real estate is the greatest investment there is. It's the earth, it's the thing we all live in. They aren't making any more of it, and it can also provide all kinds of different ways of return, not just financial. So peace of mind and vacation and agriculture, and gold comes out of the earth, so does oil. So big proponents of that. We've had the show on, it's been on radio for 22 years and continue to get millions of downloads on the podcast. It's crazy great.
And give us just a little, bit of more information on your Investor Summit at Sea, because I really can't talk about it enough. I'm not pumping for them, and you didn't pay me for this, but I really...
But I'm thinking I need to now. So yeah, Investor Summit at sea.com. Go to our site. This is our 18th year coming up in June of 2020. We go on a cruise ship for a week, and we spend time on the days at sea in workshops and classes and seminars. We've had people like Mark Skousen and Peter Schiff coming back for his 8th year, I think. We also have sales legend Tommy Hopkins and his wife that come with us. So it's pretty diverse. Ed Griffin, who wrote The Creature from Jekyll Island, has been with us the last 4 years.
Don't forget that little well-known guy, Robert Kiyosaki.
Mr. Kiyosaki often comes with us, and a few hundred real estate investors and other investors. So we'd love to have you there. And I think that kind of segues into, this is my 9th year at FreedomFest. And what I love about this conference and about what Mark and Joanne have done here is they assemble a huge variety of people. Have you noticed that not everybody agrees on everything here? But that's a good thing. You always talk about like-mindedness, and there's an affinity to being like-minded with somebody, but it's also great. You can learn a ton when you listen to someone who has an opposing view. And what Mark's always been great at is being respectful, listen to both sides. Robert Kiyosaki talks about the 2 sides of a coin. There's the one side of a debate and the other side, but there's actually a third side. That's the edge of the coin. And if you can discipline yourself to stand on the edge before you make a decision, then you'll be a much better person and investor for it. So I think we're going to learn a lot of good stuff today.
Thank you very much, Robert. And I am, again, Michael Flight. Concordia Realty invest in retail shopping centers. We primarily invest in the South and Southwest. Everything we always say, except we try and avoid California for some obvious reasons. But we love the United States. What we really like about shopping centers is they're called triple net, so that it's an inflation hedge because the expenses are paid by the tenants, so that when the real estate taxes go up, the insurance goes up, and the maintenance goes up, that's all covered in the increase by the tenants. And one of the other things that sometimes happens with retail real estate is tenants pay a percentage rent. So as they charge more for their sales and they charge more for the products that they're selling, you end up getting more rent through the percentage rent. But now what we're going to do is kind of segue into, I'm going to ask Dana a really hard question. So my understanding is that there's is it a meteor or and it's filled with gold, and so I think that's going to really bust the gold market. So tell me your opinion on that one.
It's an asteroid.
Okay, an asteroid, that's right.
That they've actually shot a spectrograph at, and they've determined that it's got $75 trillion worth of gold on it. But I think the cost per ounce to get it here was going to be quite high. So I don't think that'll work in reality, as some real estate's really good, but
but it's hard to get to.
But gold is out of this world.
So why would you encourage somebody to invest in coins and precious metals and that type of thing?
Well, gold is a natural hedge against traditional paper assets like stocks and bonds, and it has steadily appreciated against most currencies since the U.S. went off the gold standard, both as a gold currency in 1933 and as a dollar in 1971. So it went from $20 in the 30s to $35 an ounce, In the 70s, it went from 40 to 800. It settled back down into the 300 to 500 range. Now it's in the $1,400 range after running all the way up to $1,900 at the height of the crisis. So when the crisis of 2008 hit, gold did exactly what it's supposed to do. Depending on where you start, $700, $800, $900 an ounce, it doubled in price. Because it is the world's oldest and most trusted form of money, it has no counterparty risk. It is an asset class unto itself. It's the oldest and most trusted form of money, and it's internationally recognized. It's real portable wealth. You can hold $100,000 worth of gold in your hands and carry it wherever you like to carry it, subject to some import and export controls. But even that is a way. There's ways to get around that if you absolutely have to. So gold is a way to take some of the profits you might make in real estate and get your money out of the dollar into another form of money. So you're not in something that's constantly being depreciated by continual printing. And now we're in a situation we've never been in before, where there's massive debt in the world. I mean, we've never seen the debt levels that we've seen today, any time in history, on a global level. And this is ultimately a recipe for disaster, because the debt is getting so big it'll never get paid back. So the only way to deal with it is to inflate it or to devalue it. And they're trying to inflate the currency so they pay less actual real dollars back, but that is proving to be a problem. And if we're going into a kind of a global economic slowdown, which we actually are at this point in time, which is why the Fed's talking about actually cutting interest rates when the US economy is still relatively healthy. It's the other parts of the world that are weakening right now. China and Asia are weakening.
Can I just, one follow-up, why did gold blip up, because they started worrying about what the Fed chairman was talking about? I mean, how could that possibly be correlated?
Well, at the beginning of May, the 10-year Treasury yield was 2.5%. A year ago, it was over 3%, and it was going higher. Now it's gone over, which is a signal of economic weakness or slowdown. So if you have an interest rate of 3% and inflation is 1.5%, well, you get 1.5% of real return, right? Now, if the interest rate drops to 2% and inflation is 1.5%, now your real rate of return has been cut to a third, to 0.5 percentage point. This is where gold really shines, because it has no counterparty risk. It can't be devalued in the way that paper money can be, and it's more easy for it to compete, which is why when bond yields drop, the bond prices go up. That's a bit of a flight to safety. This is also what's happening with gold. There's a bit of a flight to safety, because if we have to start cutting interest rates to stimulate, that means you might print more money again. Okay, this is more devaluation actually through dilution, and gold likes this environment. Gold loves cheaper money, and we're going into a phase where money's getting cheaper. And you can see it on the charts if you take a look at them.
Okay, thank you. Lane, I know not only are you a successful investor, but you also have a fantastic mentoring program, and you've got a club that people can participate in, and Lane goes around the country and meets with individual investors, and they all kind of look at deals together and discuss deals, and he explains to them how he looks at it, and that's on your Simple Passive Cash Flow website, right? But why don't you tell us a little bit about why you like investing in some of the things that you invest in?
So, I do real estate, but it's not the typical real estate you see on HGTV, the house flipping shows. Make no mistake, that is speculative real estate. One of the big rules I have is don't lose money. How do you do that? Cash flow investing. The income you bring in by the monthly rents is paid by the tenants. And you have some expenses, but you still make money after that. And that's what allows me to quit my job and put food on the table every month, is the cash flow. And the nice tax benefits that you get from that.
And can you talk a little bit about how those tax benefits work? I mean, are you working with depreciation and that's sheltering your cash flow? A little bit more about that.
Yeah, so just a little bit of a primer here. When you are a real estate owner, like a simple rental property, one single family home, we all know as homeowners you're able to depreciate or take the interest deduction off of that. but as a real estate owner, you're also able to take the depreciation. So over 27 years, you can deduct the depreciation of a property. So my first rental property was $350,000. This was in Seattle, Washington. 27 years of depreciation, I was able to deduct maybe about $8,000 per year. So if you were making 100 grand, you take that 8 grand off your 100 grand of AGI, now your AGI is 92,000. That sounds cool, but when Trump's new laws right now with bonus depreciation on some of these larger deals that we do, you're able to do a cost segregation. So what that is, you get an engineer, not me. I don't want anything to do with that stuff. I'm done with that kind of stuff. But an engineer will go in there. They'll take inventory of all the components of the building and they'll depreciate it, a lot of it, a good 30% of it in year one. I don't know what all goes in the calculation, how it goes to the CPA, but when I invest 100 grand as a limited partner in a deal, I'm seeing anywhere from 60 grand to 85, sometimes even 90 grand of year one bonus depreciation coming back at me. And I don't believe in 1031 exchanges. We're going off to Puerto Rico. I mean, with the bonus depreciation I get from these deals, I mean, I legally don't pay too many taxes, if all.
And I just want to point out, this is my mandatory disclaimer, that none of us are CPAs or financial advisors or attorneys, so you should always talk with your CPA and attorney about your individual situation there. So with that, Robert, why don't you talk about a little bit about some of the things that you are really interested in and what you really like as an inflation hedge?
Excellent. So these two things are both awesome, right? So I love gold. I love gold for the reasons Dana said and even some more reasons. And I think the counterparty risk, if you don't have your mind around that, that's the most important thing to think about. Every other investment you have, there is a counterparty liability most likely. And in gold, there's not. It's physical gold that you can hold in your hand. And I think it does preserve wealth and it's a great hedge. What it doesn't have is cash flow or tax benefits. And what Lane's pointed out is the big reason to invest in real estate is to have cash flow that comes in every month through the efforts of others. Every day, our tenants get up and go to work for somebody else that we don't have to manage, and they take the lion's share of their paycheck and send it to us. We make the payments to cover our mortgage and our costs, and then the extra money left over, we get to keep. The bank doesn't get any of that. We get that money, and as you own more and more real estate, that passive income increases, and the tax benefits make it that much better. Now, I like to say don't let the tax tail wag the investment dog. You don't want to invest just because of the tax side of it, but I'll tell you what, with the new taxes, there's some real reasons. Lane was very articulate about this bonus depreciation. That's a great reason. There's also a thing in the new tax law about opportunity zones. Maybe you've heard of this. An opportunity zone is an excellent potential investment because of special tax treatment. Now, we probably don't want to get into the granular details of that, but there's a lot of information out there that you can find out. So what I like is to be able to pick an investment and to put together a portfolio that's going to do well when times are good and when times are bad. So I always have metals in my portfolio, and I buy from Dana. And I always have real estate in my portfolio in a variety of ways. And there's two primary ways to invest in real estate. Lane's talked about them both. He's certainly done them both, which is to actively own a property like a rental house that someone else lives in. My mentor, Jim Rohn, said that kids should have two bikes, one to ride and one to rent. And same thing with your house. Live in a house and have one to live in and one to rent out. And you're maybe, even rolling up your sleeves and doing the work and painting it and making it cool. That's an active investor, a hands-on investor. And then there's a passive investor, someone who invests in real estate through, for instance, one of the shopping center private placements that Michael does, or through a syndication that Lane puts together, where you don't have to do all the work, find the market, vet the team. You bet on a person who's done that. So you have to make sure you're doing your due diligence there. We say it's important that you have a great horse, but you need an excellent jockey, and the jockey is the manager and the horse is the project. And then also that runs on a track, which is the market that you're in. So if you do it right, real estate can provide all kinds of benefits. It can go up in value over time. It can create cash flow in the now. It can give you tax benefits, and it's something you can leave to your kids.
And I just want to follow up one more. Do you want to describe some of the real estate developments and investments that you've done over your lifetime and how you've kind of like built a different portfolio, so things go up, things go down, and you've moderated that a little bit?
Yeah, so when you start out in real estate investing, who does not yet own any investment property? You don't yet own any investment properties. Anybody not own? Oh yeah, excellent. So we got almost all investors in the room. When you start off, usually you're going to buy a single family house. Leah and I were talking about this before we got started. Like, gotta get rid of one of those houses. But when you start, that's the thing that makes sense. You probably grew up in a house, and so you understand the house. It's a very simple economic model. I mean, I definitely have some stocks, and I read the report, and I'm like, I'm not even sure what this company does. But real estate, like someone lives in your house and pays you rent. There's the economic model. That was pretty easy. Or they rent a space in your shopping center and they pay you rent. And what's great about retail is they'll also sometimes pay you that percentage if the business does well, which is brilliant. Plus, all the costs are borne by the tenant. Not always true in residential.
And I just want to interject, if it's McDonald's or Walgreens, they just electronically send it to your account 5 days beforehand. So
Don't you love that?
You never have to worry about knocking on the door for it.
Those are what we call credit tenants.
Yeah.
So when I rent a single family house, I'm dependent upon the credit worthiness, if you will, and the viability of the income my tenant has. And if I choose wrong, or my property manager does, depending on the state I live in, it can be a long time before I get possession of my house back. You don't have that problem in gold. If you have the gold, it's your gold, right? You might forget where you put it, so that's another story. But with these kinds of investments, where it's a triple net investment and you've got great tenants, your concern or risk about the durability of the income goes down, which is why I like that. For many busy people, passive investments make sense. But some people are mavericks. They want to do all the work and get all the benefit. The great thing about real estate, there's not a right or wrong. I started as an active investor. I bought a duplex, lived in half of it, and rented the other half to my sister to start, and then she moved out. I got a real tenant, and my first investment philosophy was I'm just going to keep buying houses to live in, and I'll keep the old house as a rental. Until my mentor said, well, why would you keep a house as a rental that you wouldn't have bought as a rental? Like, there could be a better rental property than the house you happen to have lived in. I went, oh, so there's some strategy involved. From there, we started investing in apartments, a lot of reason to love apartments. And from there, in the early 2000s, I got the development bug. I was passively investing in a project in Phoenix, and it turned out really great. And before you knew it, I was inviting friends, and finally the promoter said to me, you keep bringing money to this deal and you're not getting paid anything for that. What if we do the next one and you could be the developer? I'm like, I'm not a developer. I just tell people about a good deal. And he said, well, I'll write shotgun, and I'll be your construction manager, and I'll help you get the loan, and you'll just be, the person who's at the orchestra conductor. And I got the bug, and we went and did that. We developed here in Las Vegas. We developed in 6 states and several other countries, and that's led to a development career, which I hardly ever talk about, or never talk about on the radio. But it's that perspective that real estate will adapt to whoever you are. We talk a lot on the Real Estate Guys about personal investment philosophy. Every investor is different, so you got to get in touch with who you are. If it doesn't feel right to you, don't do it, because there's so many other ways that you could invest. For me, my favorite thing is to invest passively with people that are doing the thing, right? Michael's got a great shopping center where he's done all the market research, he's been there, he's vetted the tenants, he's got management in place. Like, that's the hard work. Now, I could just put $100,000 in that deal. That's awesome. I get many of the benefits, but I don't have the responsibility. Now, for some people, they don't have $100,000 or 50 or whatever the minimum is. Well, real estate's a great place to get started with sweat equity. There's a thing called wholesaling, where you find a really good deal and sell it to somebody else for a couple of $1,000s. That's how you can get started in real estate with literally none of your own money. So it can answer a lot, but all real estate's not the same. That's why it takes study, education, and getting in touch with who you are.
And he's really humble, but when he talks about international investing, he actually was the largest development project in one particular country. I think you're the largest employer, too.
We're the 3rd largest private employer in the country, but it didn't start that way, right? It started as just, 3 people in a dream.
So, and Dana, I'm going to put you on the spot. Aside from being too heavy to carry, what are some negative parts about owning gold?
Well,
That the spot was a good pun, by the way, Michael.
Well, gold, it's an asset. Some people call it an investment also, and it can go up and go down in value. So it doesn't always do what you want it to do. There's storage issues. You have to be able to store it safely where you can sleep at night and also have access to it, because that's the way most people want it. Sometimes the two aren't always synonymous with where you want to do it. So typically people have put gold and silver in bank safe deposit box, but some banks are now writing precious metals out of their charters. And if there's ever a banking crisis, that may not be the place you want to put it. If you need to have a safe in your house, like the last house I renovated, I put a in-ground safe in. So I don't live there anymore, so, so don't go looking for it. Right, but that's something you can do. And it doesn't produce returns, and it doesn't give you tax benefits like real estate does. But what it does give you in some ways is a peace of mind. And if you think about gold as an insurance policy for the rest of your money, you know, you have health insurance, you have life insurance, you have car insurance, you have house insurance. Every 6 months or so, you have to write a new check. If you get a golden or silver insurance policy in place, you're going to have the value of that policy for yourself going forward. If things are really good, the value of your policy will go down some, but you usually should get 75 or 80% of it. If you really need it, like we needed it in 2009 against financial crisis, that premium or the value of your policy is going to go way up. So it gives you peace of mind, and it gives you a hedge. It is, you know, it's been considered a barbaric relic, but what's happening today that most of you may not be aware of, and this is a big thing.
He's the Golden Barbarian. That's his new nickname.
Central banks around the world, and particularly in Asia, are buying gold at record rates. Russia has sold all their treasuries and they're buying gold. China has been buying gold steadily for the last 10 years. India has a huge gold culture. We don't have this kind of a culture in our country, but around the world they do. And when central banks start buying gold, they're buying it as a hedge against currency problems with other currencies, with other countries. It's not Lehman Brothers or Bear Stearns we're going to have problems with going forward. It's because the debt is so high. Literally, central banks are insuring themselves against the treasuries they hold from other countries. And this is going to help to buoy the gold price because the demand is very large. Out of the ground every year, we produce about 2,500 tons of gold around the world. China by themselves over the last 4 or 5 years have been taking that much gold off of the international market, let alone what comes out of the ground in China. We don't know how much that is, but they keep that all for themselves. And at some point in time, the Chinese are going to grow big enough and strong enough to challenge the dollar with their yuan as the international currency or the world's reserve currency. Now, we enjoy tremendous benefits having the world's reserve currency. You know, as prices of commodities go up or down, we don't also have currency valuations that every other country has, like Great Britain or the Eurozone. Look what's happened in Argentina and Venezuela over the last couple of years. Their currencies have just nosedived because their economies have tanked, and inflation has been rampant. Now, we're insulated from that because our currency is the currency of the world reserve, but if the dollar gets dethroned by the yuan, then we're going to be subject to the same kind of currency shocks in addition to commodity shocks that some of these other countries have been subject to forever. And since they don't have the transparency of economy that we do or markets, I think part of their strategy is to partially back the yuan with gold when they do finally try to do this. And it may be years from now, but the fact is gold's not going to get a whole lot cheaper in dollars. And I think we're in a trend now where we might be in a trend reversal. And if we go into a slowdown, gold could go seriously higher. It's a way to get out of dollars, as I said before. Take some of your money and get it out of a currency that's just going to devalue.
Okay.
So.
And thank you very much for that. Lane, there was a special fund that you were putting together for mobile home parks, or or manufactured housing communities. Can you talk a little bit about that and why you think that that's a good asset class to invest in? Because I really find it a fascinating asset class.
Yeah, so kind of my progression has been turnkey single-family homes, and then going to multifamily apartments. Very logical progression, right? Something an engineer would do. Multiple roofs, you know, Class C, B housing, workforce housing, which we need more of, and great Fannie Mae, Freddie Mac government subsidized loans for that, where a lot of it is non-recourse debt. But those benefits are also the reasons why the space is very heated at this moment. So I'm sort of a contrarian investor. Don't get me wrong, I like the space and I still am 80% in multifamily apartments, but I'm just trying to, as I learn from more astute investors than myself, people will diversify over several asset classes. So mobile home parks is one industry that I personally like. I think it has a little bit better cash flow. It's not as hot, so you won't have a huge appreciation spikes, but hey, we're not buying for appreciation. We're trying to force the equity ourselves. So I think most investors are very polarized to this investment class. It's very dirty. In Hawaii, there's no mobile home parks. Well, I've never been in one until I went and visited it last month. But they're a lot nicer than a lot of my Class C and B multifamily apartments.
Well, come over to my trailer anytime.
Yeah.
One of the great things about mobile homes is that for the tenant, there's two great things about it from not that you've asked, but is that you get more space for the rent. I mean, it's a bigger place. Anyone been in a mobile home before? They can be nice. I mean, they're single wide, double wide, triple wide, right? And the other thing is they pay a space rent, which is where the opportunity is, but they also, many of them can own the home, so they don't behave like all tenants do. They behave like a combination between owner and tenant, and especially in the nicer parks, now they own the house, and sometimes they have a loan against it, and your space rent is a relatively small part of their overall budget, but there's no way they're not paying it. It's the most important part. So getting paid is also easier in mobile homes, but the returns can be a lot higher if you're willing to go in that space.
And a lot of the benefit is, we'll pick up a park where it's going to be mixed, owner-owned and operator-owned. We're trying to get it to these tenants will own their own properties. So if they screw it up, that's on them. We just own the concrete slab and we're just renting out that property, as opposed to single-family home owners. And right now I have like a $30,000 bill that I got to fix up. Right? So I don't have to worry about any of that kind of stuff.
Well, and one of the other nicer things about mobile home parks is that since we're here at FreedomFest, it's government scarcity. So the government, local municipalities don't want mobile home parks, and so they're not building a whole bunch more of them, so you don't have to worry that like the next time there's a giant thing where everybody's out building office buildings, or you can see all the casinos being built here and hopefully they'll be able to be filled. Mobile home parks, there's a lot of zoning regulations against them. So once you do get a mobile home park and it's already zoned, you're probably not going to have a bunch of competition with it. So that's another great thing about it.
Right. Two reasons for that. Obviously, they're an eyesore. So a lot of the people voting these people in position don't want this in their town. But what it really is, in my opinion, is you can't really tax these developments. So a lot of municipalities, they don't want it in the first place. So at the end of the day, whatever it is politically, they're not making any more of this. So it's an endangered species. So I like
Well, and it's also an excellent long-term land bank in many areas, because if you think of where mobile home parks went 10, 15, 20 years ago in the outskirts of town, now town's grown around and there's typically a large piece of property that's got these trailers on there. That could become very valuable at some point in the future. Now, maybe your great-grandkids, but at some point, it's also got the side benefit. Besides great cash flow from someone who acts like an owner, there can be a great exit strategy.
Yeah, so fantastic.
I've seen that firsthand in Austin, Texas, which has just exploded over the last 10 years. And what used to be out in the boonies is now part of town. And there are some really big pieces of property that are mobile home parks that used to be on the outskirts that are now within the city. The city proper.
I had a friend who owned a mobile home park in Southern California. It's on the ocean. Have you seen these? They're like $600,000 for a mobile home, and their space rent's got to be like $2,500 a month. And that's not your average mobile home, though.
Yeah, I just passed one just south of Santa Barbara, and it's like overlooking the ocean. It's right there. I mean, you can't beat that location, and it's just like there's 5 or 6 of them right there. It's like it's got to be $4 million real estate under each one of those.
I have a question, if I can, Michael.
Sure.
When it comes to retail and shopping centers especially, there's this belief, I think, that retail's going away, everyone's going to buy everything on Amazon, that you're in a dying, class of real estate, but that's actually quite the contrary. Can you educate us on that?
Well, I will say that in the United States, the United States is over retailed. So there's a lot of like what we call Class C malls that we're the third mall in the market. You've got the really good mall, and then you've got the kind of good mall, and then you've got the Class C mall. And so a lot of those type of shopping centers are going to go away. And then you've got some excess tenants there that really don't have any reason for being. So like, I cannot believe that JCPenney and Sears are still in business anymore because nobody actually shops at them. And the guy who bought Sears was a hedge fund guy, and when he bought it, should have just converted it into a real estate investment trust and divided up and got rid of Sears and divided all that up, and all the Sears shareholders would have made a lot more money that way. But the other thing that I always explain to people is right now, online sales are between 12 and 14% of total sales. So you're still getting close to 85% of your sales in physical retail. The other thing I always say is that Amazon bought and paid 250 something, billion dollars, or it's not that, but they paid a lot of money for Whole Foods. And what they wanted with Whole Foods is a physical presence, because they realized, and once Walmart figured out, and once Target figured out what Amazon was doing, those guys are doing, you can order it anywhere. If you want it at the store, you can order it, pick it up at the store. If you want it delivered, Walmart even has a thing called geofencing, so they know when you're 3 miles out and about 5 minutes away, and they supposedly have it down so that when you pull into their parking lot, they can get the goods that you ordered online like just a few minutes ago. They'll have it out to your car in 3 minutes. And they're also, Target and Walmart are redesigning their stores so that there's a specific pickup area in there. So it's going to be a mixture of online and physical presence. And what I always say is if it's good real estate, it's good real estate. So even if it's not retail, most of those retail centers that are in good locations, we've torn down a few malls in the past, but we're actually looking at some of the deals that we're doing and tearing down the back half of it, and because it's in a great location, putting in residential or selling it off to a prominent residential developer, and then taking the rest because you didn't need that much space in the back, and you're right-sizing it. But it's still in good physical location. So we always look at it's really, really important in retail is location, more than even houses or apartment buildings.
I think, when we connected 2 years ago, and you were telling me what you did, I was like, who's this guy? Don't you know Amazon's gonna take over the world?
I get that a lot with people his age.
But as we started to talk and I started to learn about the space more, I started to realize you're not going after the large shopping malls. You're going after that neighborhood shopping center with the hairdresser,
the grocery stores, the daily driver things. And the other thing that we also look for and we try to put into our shopping centers, I'm sorry to interrupt you, but dental or medical uses, because those guys, you can't do most of it online. And also they put a ton of money into their physical location, so they're less likely to move. So, and if you've got anything to follow up.
Well, it's just like any asset class. If you get that cringe initially, that probably is a good reason why 90% of the dumb money will not go there, and that's where you should go as a contrarian investor.
And right now, historically, we're getting some higher returns than if you would be investing in apartment buildings, because a lot of people are loading into apartment buildings. So there's some better returns right now in shopping centers.
And that's also Lane talks about the contrarian thing. The reason that the apartment space has been so depressed, not that it's not popular, it is, but I mean depressed in terms of what we call cap rate compression. The cap rate is the return, and if all of us are willing to pay more and bid the price up for the same stream of income, well, then the return goes down, and everyone's in apartments, right? Everyone's in apartments, and it's great. It's just hard to find good deals that have good returns, so people have to accept less. In some of these alternative assets like mobile homes and even certain retail and shopping, there are better there are better returns, and it really isn't the risk parameter isn't even worse. Sometimes it's better. It's just that there's less money chasing it. So to Lane's point, sometimes you got to go the place where everybody else isn't going.
Yeah, I tell people,
Robert and I have been through 3 downturns. He's been through like 1 or 2 more, but it's like it's really cyclical. So
Can you imagine? Bob was back into real estate before there, was ink and paper. It was just like, tablets and stuff. It was crazy back then.
I actually have a Walgreens lease. It was done before zip codes, so it was on like onion skin paper. There's no zip code on it, and so they've been there for more than 60 years. So, and but yeah, I mean, it's so you can kind of see apartments were great to get into before. They're kind of peaking now, and so you just got to kind of look. I'm not saying don't go into them. I'm just saying look at what you're, can you really get the value add? And a lot of the past returns are, past returns, and are you going to get those going forward? So it's just try and be an informed investor, and everybody up here is willing to talk to you about, what particular you're interested in and how we can educate you. Because as I always like to say, this guy is more about education than anybody I've ever met. I mean, they're really, their whole setup is about educating investors. And then Lane also does this, and then since I've met him, and we hung out on the cruise together, and he played guitar for me on the back end of it. But just gave me a master's degree in gold. So.
Well, I actually bought duplexes in Austin in 2013 when the market was at the bottom, because I had a windfall from my business and I had extra cash. And I've always liked land for the same reason I like old coins. They're not making any more of it. It was only a couple of years later that I met Robert Helms and Russell Gray, and I went on the Summit at Sea, which is one of the most educational weeks you'll ever have in your life if you are a serious real estate investor.
Repeat, please.
The Summit at Sea that the real estate radio guys put on every year is one of the most educational experiences you can have for a week in your life. And it's not, you go on a boat, and they do it on a boat for a reason, to get you all captive and keep you in one place. Okay, now I'm serious, but it's fun. It's not a cruise in the traditional sense. You're going to class most all day, every day, and you're meeting some of the most successful real estate investors there are on the planet. And they're all levels, all breadth and depth, and they'll share their knowledge with you gladly. I call it one of the most unassuming groups of overachievers I've ever met in my life. And if I'd known now what I should have known when I bought my duplexes, my strategy would have been different. We buy where we know. And there are markets you can go into very comfortably that you don't have to live in, or I was very conservative. I put too much down, and I could have bought twice as many properties as I did because I was just being too conservative in my own head. Now I know so much more about it. If I have another opportunity like I've had before, I'll know who to talk to, where to go, how to harvest what I can do much more efficiently for myself and much more productively.
We should probably open it up if anybody has any questions, and anybody, if you want to just step
Hey, there's a microphone for
Yeah.
questions, and we
Yeah.
have like 7 minutes, so.
Yeah,
I think you were in the.
because all of us could
leadership
talk all day
When I had a
long.
question about real estate, and do you remember the question?
Yeah, so you asked Peter about apartments specifically, right?
Well, Peter Schiff was talking about getting out of U.S. stock and bonds, and my question was, well, what do you think about real estate? And I know you know Peter Schiff really well. I was just wondering if you can kind of
Yes.
maybe answer that.
Yeah,
I
so-
should have probably directed that to you because I saw you sitting there.
That's good. Peter's a great friend, and Peter has predicted 19 of the last 2 recessions. And I think Friday night Wednesday night when I got here, I saw him talking to Stephen Moore, and I went up. He's like, "Hey," I'm like, "I don't want to interrupt you telling Stephen why he's wrong," but so here's the thing: some real estate is overpriced for sure. And is there another bubble? And are asset prices high? Absolutely. We got to be careful right now. We're buying not at the top, but maybe near the top for sure in some markets. But recession-resistant real estate is the fact that there is no technology we're ever going to see that's going to eliminate the need for human beings to sleep under a roof.
Right.
And real estate has a real tangible value, unlike a stock. I mean, a stock represents value in a company, but every single dollar that goes into the stock market or oil or gas or gold, every single dollar is discretionary. Real estate's, that's not true. You can't sit out the real estate market. So I think that there is some real estate that's always going to survive the downturn. And see, this is a great example. I mean, this isn't even a great example. Next door, Planet Hollywood is a great example. Who's been to Las Vegas long enough to know what Planet Hollywood used to be when it was built? It was the Aladdin. So it was built as the Aladdin, and that business failed. But the real estate is still there. So real estate will survive the comings and goings if the ownership is right. So I definitely think that Peter's got a lot of interesting thoughts, and that's what's great about FreedomFest. You listen to what one says, what another says, what a third says, and then you put this all together, right? There's a pretty disparate group of investors that do different things, but hopefully it inspires you to think about how it's going to fit in your portfolio.
Yeah, I just kind of like thought about that. That wasn't really my question, but I saw you, and that just kind of came up. But there's a segue into another one. Cap rates. You three gentlemen, what do you look for? You can keep it as brief as possible.
You want to take that lane?
Formula.
Yeah, I don't look at cap rates at all because, first of all, they're always manipulated. Think of what a cap rate is. Your income minus expenses derive your NOI. A broker will always give you a cooked NOI sheet. So I go in, I just look at the trailing 12 P&Ls, and I see if it's making money. If it's making more than the rest, then I buy it. Right? I only buy the top 1% of the deals I see.
So you just do it out ROI, cash on cash?
Right, because sometimes...
what's that look like?
Well, sometimes a owner who you actually may want to buy from, they may be actually doing their numbers properly and may be showing a very low cap rate. So that's why I don't go off cap rates initially.
What do you go off of?
I go off of the cash flow and then the
So what do
ROI.
you use? What's the cash on cash return?
Yeah, but I apply my
Yeah.
thought of
What
what
is
the
it?
expenses should be.
Well, what do you look for?
Is there a percentage
Yeah,
that
do you
is
look
the
for it, or
threshold?
do you just kind of like?
Apartments these days, if it's a stabilized building that's cash flowing today, you should be getting about 8 to 10% pay, and you should have some forced appreciation to increase those rents, maybe $50, $100 per unit.
Okay.
And that should be able to get you 80 to 100% in 5 years.
Probably a little higher in mobile homes.
Yeah, about under
Depends, right?
Yeah, under promise, over deliver, right?
Right, yep.
So you look for 8 to 10% cash on cash return, or 8 to 10% cap rate? I didn't catch that.
No cap rate.
You don't even look at cap.
I don't look
Okay.
at cap at all.
Yourself? You can keep it brief.
We don't really, we're not cap rate buyers because a lot of the stuff that we're doing is value add. So if you've got a certain income and you know that the income is going to increase, it might be a low cap rate. We look more at price per square foot. So one of the things, like we're looking at a deal now right outside of Reno, and we can buy it at $100 per square foot. And so the cap rate is around 7 to 7.25, but it's not the real value because there's 50,000 square feet of vacancy. So we know that we can fill that vacancy because we've already got a tenant for it. And so really our pro forma cap rate is probably going to be closer to like 9 or 10. But so it's not necessarily the cap rate. And then the other thing is what we like to do is if it's got out parcels like the McDonald's or the Walgreens or the Applebee's or something out in the front, we like to subdivide it and sell those off. So if we can buy the entire shopping center, what we consider wholesale, and then subdivide it and sell off those smaller pieces retail, we can sell off the smaller pieces for like $250 to $450 per square foot. So that we arbitrage on just buying kind of wholesale.
You're a clever guy. That's awesome.
Appreciate it, thank you. And you can keep it brief. 'cause I know
Yeah.
people-
Well, similarly for apartments, 80 cents to 90 cents square foot for rent. If the market is showing like $1, there's that gap. That's really what is making the difference if you buy the property. How much can you increase those rents based on the comps? And they gotta be real comps too.
Right now, cap rates are depressed in a lot of market rates, but you want to sell when the cap rate's high and buy when the cap rate's not, or other way around. I mean, I'm also not a cap rate buyer, but I'm a cap rate seller. So when the market says it's time to sell, we'll do that. We have 1 more minute.
Sure.
I'd like to know more about mobile home parks. Do you buy the individual units or the whole park? And then I'd also like to know the downside to that. Are local utility, or local cities allowed to condemn units as they grow older, and any other negative comments that you might have?
So
And you have 45 seconds,
So
Lane.
you typically buy the large park as
Buy
a
the whole park.
Whole park. So usually there are like 50 units or 100, 150 units. And to answer your question, most of these parks are like septic. So you're outside that jurisdiction. So, but, you know, it's real estate. There's risks, right? And you try and mitigate it appropriately. You get engage in engineers, you engage consultants and contractors to get you back in compliance.
Well,
So
you
you
also try and mitigate your regulatory risk, because you want to make sure what the town is and what's around it. And, you know, like, we're mitigating our regulatory risk by no longer investing in Illinois. So that's,
Is there any easy way to find out what all those risks are?
Yes, get Lane's book called Simple Mobile Home Passive Cash Flow Investing. And when he writes that in a couple of years, you can do that. Lane is a Amazon best-selling author, so you can ask him about that. And in the 30 seconds remaining, Michael, you should probably tell people how they get a hold of you.
You can get a hold of us at concordiarealty.com. That's concordiarealty.com. And Dana, why don't you give your information too?
Yeah, our website is, we're American Gold Exchange in Austin, Texas. Our website is amergold, A-M-E-R, gold.com. Just that simple.
If you guys listen to podcasts, Simple Passive Cash Flow is my podcast. It's kind of a follow my journey podcast, and the URL is simplepassivecashflow.com.
And we're the Real Estate Guys, realestateguysradio.com, or just the Real Estate Guys on iTunes or Stitcher or any of your favorite podcast areas. And gosh, thanks for coming, everybody.
We really appreciate you coming. Thank you.
Thanks to FreedomFest.